Hi, and welcome to the July 2018 Downtown Pittsburgh Investors Business Daily Meetup. My name is Eric Rossi. I'm the co-organizer of this meetup group. And on this slide, there's a link to our meetup group's homepage, in case you found this through YouTube or some other means. So the goal of this group is to educate individual investors about the CAN-SLIM investing strategy. And this presentation is for educational purposes only. I'm not providing any recommendations to buy or sell securities. Investing in stocks carries substantial risk and you can lose your money. I'm a non-professional volunteer investor, and there's some trademarks listed there for some of the tools to be discussed here. And the prerequisite, this video assumes that you're familiar with the CAN-SLIM investing strategy developed by Investors Business Daily. And at a minimum, viewers should have read this green book here, How to Make Money in Stocks by William J. O'Neill, who's the founder of IBD, before viewing this video. You'll get more out of it that way if you understand the strategy. If you have not read anything about it, you're certainly welcome to listen. It might just be a little more difficult to follow. Just a few topics for this quarter's presentation. The first one, we'll do the market dashboard as always, and then we'll go over some recent holdings from this quarter, and then we'll conclude. So mostly this month's going to be a review of quarter two and the trades that I closed out that I think provide the most meaningful lessons out of those. Okay, the market dashboard, we'll start with the short-term indicators. We are just coming out of a 5% correction in the NASDAQ, just barely 5%. It was like 4.95 or something like that. That just ended as of this recording. So that's a good sign right after market pullbacks. The market does tend to rally. We haven't had a 10% correction since April, so it would be nicer if we were coming out of a little bit of a larger correction here, but this was relatively recent. And the big thing is we really haven't had a big correction in the market for a really long time now. You can see here we're coming up on 7 years, and that historically is a very long time. So historically speaking, we're overdue for a major market correction. Not that that means it's going to happen anytime soon. I certainly don't know when it's going to happen. And it's just something to be aware of, that this is something that we'll talk about a little bit when we review some trades from the second quarter. The NASDAQ chart pattern right now is pulling back, and it's been volatile recently as we've had all this talk of trade wars and tariffs on China and other foreign goods. So there's supposed to be a decision this Friday on whether or not those trade wars are going to happen. Those tariffs are actually going to be imposed. If they are imposed, my guess is that the market is going to drop significantly, and it could be a good thing in the short term, because when the market tends to have a big correction and starts to stabilize and come out of that is when the leading stocks tend to make their biggest moves. But who knows? Anything could happen. I'm keeping a very defensive stance for right now, just holding a few stocks and mostly in cash, because I just don't want to take the risk of holding, knowing that there's a big risk out there that the tariffs could take place, and that's probably going to be viewed negatively by the market. And the NASDAQ is just above its 50-day moving average, so that's good. The Federal Reserve activity, they just raised interest rates for the second time this year, and they expect 2 more increases in 2018, which is a little more aggressive than they had thought previously. And then they're forecasting 3 to 4 more increases next year. This is a bad sign, because when interest rates are increasing and the Fed's getting more aggressive with them, it tends to be bad for the market. So far, it doesn't seem like it's had any impact really, but historically, it will eventually. And the last bull market we had ended in March 2009, a long time ago again. So it would be nice if we had a big market correction at some point here to pave the way for some new leadership to come in and some big stock gains. The last bear market ended right before then, 2009. and we've had a number of NASDAQ intermediate corrections. These are corrections on the order of 5 to 19%, let's say. There's been a bunch of these, considering that this bull market's been running for so long. Okay, I'll go through some current holdings. MasterCard, Intuitive Surgical, FleetCor, and Cactus. Again, these are just a few things I'm holding. They're hanging in there okay. They're not really doing that well, but not many growth stocks are doing well from what I've seen recently. And then we'll talk about recent holdings here. And these are stocks from the second quarter. These were ones that I traded personally that I think offer some good lessons to be learned that can be applied to improve our trading in the future. And these aren't necessarily the biggest winners or the biggest losers. They're just the ones that provided some good lessons. Okay, so I'm going to switch over to Market Smith now. And let's start with the current holdings here. I'll just rattle through these quickly. MasterCard broke out of a base back here, a flat base, and it had a gap move on pretty good on good volume here after it reported earnings. And you can see it's hanging in there. It's just kind of this is a slow mover, and it's just slowly moving up in this uptrend here. And it's kind of hitting some resistance around 200, but it's hanging on there. And this is one you got to be patient with. I mean, it's only moved 8% in 9 weeks, so we're talking 1% per week. So at that rate, it's going to take 20 weeks for this to hit my profit goal. But it's hanging in there, and I have no reason to sell it right now. It's not buyable. It's too extended from the buy point. Next one's Intuitive Surgical. This one also had a flat base here, and it broke out in good volume back here. And it had some nice tall accumulation days here. And it's been pulling back ever since, kind of with the market pulling back. But again, it's hanging in there. And this is buyable right now. It's 3% from the buy point. So it could be bought. And again, this is probably going to be a slower mover. This is a big stock. You can see the price, $500 a share. So it's trading almost, whatever that is, 300 something million a day in liquidity. So it's a big stock, and it's probably not going to make a really fast move or anything, but it's okay so far. FleetCor Technologies, this one broke out back here on a gap up day. Came kind of out of nowhere. There was no news or earnings or anything that prompted that, which usually is a better sign, but you can see the stock pulled back as the market pulled back here. But it's hanging in there. It's right around the buy point. It hasn't triggered a sell rule. And you could buy it right now if you wanted. I would wait for an accumulation day in here, an up day on bigger volume than the prior day. And we haven't really seen that recently. And last is Cactus. This one is, I think, looks the best of all these. It's kind of tightening up on the right side. You can see from here to here we had a pullback, and then we had another one here, and then we had a smaller one right here. So it's kind of like it's almost like a little ascending base, or if you're familiar with a trader named Mark Minervini, he has something called a volatility contraction pattern, VCP. That's basically where a stock makes progressively smaller pullbacks like this within a base. It's kind of doing that. And it's hanging in there. It's finding nice support at the 50-day moving average. The buy point here, there's an early buy point, I'd say, right here around 33.50. It's hovering right around that. So you could buy this right now if you wanted. Again, I'd probably wait for an accumulation day to show up, a blue day in heavier volume than the prior day. You could also use this up here as 35.19. This is the stock's kind of forming a handle right here. So we could also actually call this a cup with handle base, which is probably more valid than the other pattern I mentioned. But this one's hanging in there. And this is one I'll also cover in the recent trades, recent holdings, because I did own the stock back here and learned a valuable lesson that I can share here, that I didn't get as much out of this trade as I should have. So that's what I'm holding right now, just a few things to keep an eye on. Again, not recommendations. All right, so let's get into recent holdings. Let's start with PAGs. And what I'm going to do here is zoom back in time to what this looked like when I bought it. And I'm not going to talk about how to find these stocks. This stock was in IBD. It was probably an IPO leader or maybe another list. I'm not going to talk about how I found this or why I chose to put it on my watch list. Most of these were just I found them in IBD and or maybe I ran my own screen and found them. But I'm going to talk here really about the lessons learned out of these trades. So this stock had started, it IPO'd at 2150 here, which would be, way down here somewhere. And I can't actually draw a line down there, but you get the idea. This is kind of like a big uptrend here and then forming this base, this IPO base. And it was only 10% deep, which after the stock IPO'd at 21 and moves up to 30, that's almost a 50% move. Then the stock pulls back only 10%. And that's really nice. That's really attractive. And IPO bases can tend to produce some really good gains. And you can see the market was pulling back in here while this base was formed. So there was an early buy point right here, this early resistance point around 29, where you could buy shares right here. And then the next day it broke out. And you can see the breakout happened on some of the higher volume in the past couple weeks, and certainly higher than the day before. So we don't have enough trading days here to have a 50-day moving average for volume. But this was a good breakout, and the relative strength line made a new high, which meant that this stock was outperforming the S&P 500 at the time, probably all the indices on that particular day. And you can see it closed here. It gave you some time here to buy it. With anywhere within this blue range is the buy zone, from $30 basically all the way up to $31.50 roughly. So that was buying the stock there. I'm just going to switch to a weekly so we can follow ahead here. You can see the stock was up the next week, 7%. And if we had set a 20% profit goal on this, so 20% from the buy point would be 36 up here. So this is the profit goal up here. Okay, so let's watch what the stock does. And we would have had a initial stop loss of around 7 or 8%, which would have been, somewhere down in this range. As the stock moves up now, once it moves up 10% above where I bought it, which at the worst case would be in this case about 33 or so, I would raise my stop to a 1% gain. So let's say I bought it here at 30. I would raise my stop to a 1% gain, which would be like 30.30, right around here. So that way the stock never should go to a loss after that. And if the stock goes up to the profit goal, we have a decision to make. Do we sell it and take the profits, or do we hold it? And that's mainly what I want to talk about with this one. You can see the stock, it's got now 5 up weeks in a row, and it's very close to the profit goal. It's looking really strong. And this is the week I really want to talk about here, because I saw this stock making this powerful move, and it's an IPO base, so it's a new name, and the market was coming out of a little short-term correction. And so I was thinking, I'm not going to take profits on this stock. I'm going to try to hold it and see if I can get a bigger gain out of it, because it's an IPO base, it's a new name, it had a very nice IPO setup here, and it's advancing quickly, but not ridiculously quickly. And so when the stock hit this profit goal up here, I did not sell it. And you can see what happened here. I'll switch to the daily chart. The stock, it hit the profit goal anywhere in this green here. So this would have been my profit goal right around here. You can see that it reached up there, and it even reached a 25% gain at the top of this box here. And then it just came back, and it closed the day pretty weakly. And you can see how extended it is from the 10-day moving average. And I didn't sell it here. I thought I'm going to hang on to this. And so the next day you can see it's still hovering around the buy point, no big deal. And at this point, I'm expecting the stock is maybe going to pull back, let's say 10-15%, and hopefully form a new base. And then I can add to my position. And you can see here it's catching up to the 10-day moving average. Volume has subsided as it's been kind of declining a little bit. So it still looks fine here. I felt okay about this. And now it breaches the 10-day moving average, but again, volume's low. Volume is declining as the stock's coming down in price. So I wasn't too concerned about this. And now you can see what happens. We have a distribution day here. Volume picks up. The stock's down almost 4%. And I had moved my stop up here to somewhere around here. So I didn't do anything here. I wasn't selling for profits, and I wasn't going to sell it on the defensive side unless it broke through, basically came all the way back to a 1% gain. And you can see here the stock comes back up and flirts with the profit goal again. Okay, so there was another chance here to take profits. I just chose not to take it. And now after this, I felt good about this. I thought, okay, this thing just had it gapped up here. Volume's up for the day. It made almost a new high price. And I'm thinking this thing's going to keep going up here. And you can see now it's even above the 25% profit. So this is, I was feeling really good about this decision to hold this stock at this point. And you can see here, we've got a down day here, 5%. It came back down below the profit-taking zone. But again, I didn't do anything here. I did raise my stop at this point to this prior low. Some people call this a swing low at 32.50. So I think I raised my stop to like 32, right below that. And so let's just keep moving forward here. You can see the stock is catching up with the 50-day moving average, this red line. It bounced off it here, so that looked good. And again, I felt pretty good about the stock at this point, and no reason to sell it. Until this day, and you can see this is a really nasty day here. It's probably the widest day of trade since the stock went public. It did close off the lows, but it closed below the 50-day for the first time. And I did get stopped out here because it did trade below my stop loss. And I ended up selling this thing for like a 1% gain after being up like 30%. So that's pretty disappointing, and these are the best trades to learn from. And the thing that I kind of concluded out of this, that I've concluded also earlier this year, and I should have stuck with it here, but I didn't, is that if a stock runs up to the profit goal in a relatively quick period of time here, like this ran up in about 3 weeks, my opinion is if we're just coming out of a big market correction or a bear market, then I agree with Bill O'Neill's opinion to hold the stock for at least 8 weeks and try to hang on to it for a longer term gain. But given that the market's been running basically since the Trump election, we had a really strong market in 2017, and it's kind of running out of steam here, especially with the trade war talk is making things volatile and more uncertain. And so I think given that, my new thought is I'm going to follow Bill O'Neill's rule. If a stock hits the profit goal in 3 weeks or less, hang on to it for a longer term gain. I'm going to do that only if the market's coming out of a big correction or a bear market, which the market wasn't doing in this case. The market did come down here, but it wasn't a bear market. It was just about maybe a 10% pullback, if I remember correctly. So if the market is not coming out of a bear market or a big correction, then I'm taking these profits, because you can see here, this is really disappointing. Have all this time in here to take profits and to not do it and then only take a 1% gain. And now after this, then I'm thinking, boy, watch, it's probably just going to rally back up and go to the moon since I sold it. But that did not happen, and I'll just fast forward to today here, and you can see I'm glad I did sell it back here on this day, because now it's down below the buy point. This was the buy point here, and it's below that. It's actually testing, it's at a new low. So that's really really weak move action at this point. So I think the lesson learned on this one is when in doubt, take the profits at 20 to 25% from the buy point, and don't hold for longer term gains unless the market is coming out of a bear market or a big correction. I think that's my thoughts on this one. All right, let's move on to Cactus. Again, I'll go back in time here to this one. This was another IPO base. It IPO'd at 19 and it ran up to 28, which was a really nice move. And then it traded in a tight range here, 9% deep, and it had kind of a line of resistance right here. So you could have bought early, maybe this day or this day even. But here it tried to break out this day and it stalled. Some people, if they bought it this day, would sell it by the end of the day because the breakout never really happened. I did buy it this day and I hung on to it. And no, I'm sorry, I didn't. I think I decided not to because it reversed. Because I know I didn't get stopped out right there. Yeah, I bought actually this day right here. Yeah, I decided not to buy here, and I was glad I didn't because you can see you would have been stopped out here. Unless you gave this till the end of the day, because it only traded down here a very short period of time. This ended up being a nice shakeout day. It made a new low here and found lots of support, you can see. So let's say buying this day at around 28, and then buying the rest maybe around 29. And let's just go to the weekly and see how this thing goes. I want to talk about earnings report management on this one. Because this stock had an earnings report in here, May 9th. Okay. So this day here, I was still holding the stock here, and let's go back to May 8th. I was still holding it here, and it was up about 5% from the buy point. And I like to have at least a 5% cushion most of the time if I'm going to hold a stock through earnings. And I thought here, this is a new name. It had one earnings report here back in, was this an earnings report? Yeah, it had an earnings report here back in March. Okay, and it traded up for the day a little bit. But I don't have much history here. I have one earnings report. I have no clue if this thing's going to gap down. Is it going to be really volatile afterwards? Is it going to be unchanged? I just didn't know what this was going to do. And I didn't feel comfortable with only a 4 or 5% profit cushion to hold this through the earnings report. And so I didn't. I sold it. I took my 4 or 5% gain. And you can see the stock was up just a little bit after the earnings report. And I felt like, okay, no big deal. Maybe it's not really going to do anything. And it then had you can see delayed by a day here when it started having some accumulation after the earnings report, and it then went up and hit my profit goal, which was right up here. So I went back and thought about this, and I said, okay, I got whacked earlier this year with Roku, holding it through its second earnings report, and it gapped down like 15%, and I had to take a loss on it. So I was gun shy here about holding this stock, considering it only had one earnings report back in here. But I think the difference here, if we look at Roku versus this, is that the character of this stock it's very steady, it's not very volatile. If we just page through here, we can see it doesn't have big movements day to day. It tends to move 1 or 2% on average. Maybe 3 or 4% is a big day for it. But it's a pretty steady moving stock here. And it doesn't it had maybe like one volatile day right here, but it's a pretty steady mover. And therefore, it's less likely to have a big move during earnings and have a lot of volatility after earnings. So my takeaway on this one is if I have a recent IPO that doesn't have a lot of earnings history, I can't go based on the the historical earnings reactions to see how I might manage it. So I need to look at the character of the stock. And you can see this one's a steady mover. It doesn't move a lot up or down. It's just kind of steadily going up there. And if we compare that to Roku, back when I was holding it up in, I was holding it here, and you can see it got whacked here. It was actually closed down the day 18%. But this stock was a lot more volatile. You can just see the daily moves. I mean, it was up 9% here, up 4%, down 9% this day, gap down 10%, gap up 7%, up 13%. And this stock back here on its first earnings report, it traded up 55%. So that's a big move, and it's a lot more risky to hold this type of stock through earnings than it is Cactus like we just saw. You can see this stock's a lot more herky-jerky. It's got a lot more volatility. It had one earnings report to go by, and it had a huge move. Therefore, the probability of it making another huge move up or down is increased. So this stock, in hindsight, it wasn't worth taking the risk of holding through earnings with only a 5% cushion, which I had about a 6% cushion here. Just because of the character of this stock. So that was my takeaway on WHD and Cactus was for new IPOs, take a look at the character of the stock. If it doesn't have a lot of earnings history, like Netflix, for example, Netflix has been reporting earnings for many years, so I can go back and see what did it do on this earnings report, and this one, and this one, and this one, and I can go back as far as I want. But I can't do that with a new IPO, so I got to look more at the character of the stock when I make a decision about whether to hold it or to sell it through the earnings report. Okay, next trade is FND, Floor and Decor Holdings. This stock here was forming a nice cup with handle here. There was an early buy point here in the handle. There was an early resistance point here, or an early cheat, if you will, that you could buy some shares if it trades above there. It also has a trend line here in the handle, or you could just wait for it to break out like it did this day. So if you bought it here around 49, let's say, it had a nice breakout day on big volume, and this looked really great. And if we fast forward on the weekly chart, this stock ran up quickly to the profit goal, which was, let's see what the profit goal would have been on this. So 48.67. So 58.40, let's say. 58.40. So it almost reached it here. Okay, so this is what I want to talk about here. So you can see here this green zone is the profit-taking zone. So 58.40 is right about here. Okay, so my thought on this, I had the stock and it was close to the profit goal here. It was very close. It was within 12 cents of it. And I saw it, I didn't see it right at that price, but I saw that it was near there. And you can see it closed very near the profit goal. And I thought, should I sell this or should I hang on to it? And I had a limit order to buy at 58.40 or above. And I decided just to let my limit order trigger me out. And it was likely with this move that it was going to go up a little bit more and reach the profit goal. Well, lo and behold, if you watch here, I believe this was an earnings report day. But basically, the stock never made it. Okay, and if we go back to today here, this was the base back here, so this is where we bought it, and the profit goal was like right here. You can see it never got back up there. And I eventually on this one, I had raised my stop to a 1% gain around here, and I ended up having to sell this. Actually, the earnings report was right here. This was not an earnings report. I ended up having to sell it up here because I didn't want to hold it through the earnings report, and you can see it got whacked, 14% drop after earnings. And I was glad I didn't hold this through the earnings report. But I was disappointed on this again because I had about a 19.5% gain, and I ended up having to sell it for maybe half of that or here. I don't remember. But I could have got triggered out on this day. It probably only traded below here for a couple minutes and then found support. But I could have got triggered out here at a 1% gain. And the lesson learned on this one, I thought if a stock is really close to the profit goal here, should I sell it or should I hang on to it? And since then, if I've seen a stock getting close to my profit goal, but it doesn't look like it's quite going to make it, but if it's within 0.5% or something, I'm going to sell it and take my profits because I don't want something like this to happen again. This was disappointing, and this thing ran up rather quickly too. It ran up in only 3 weeks, 2 or 3 weeks. So again, the quicker these things run up in price, the quicker they tend to come back down. And just like we saw earlier with PAGs, these ones that run up quickly, my opinion is just take the profits and run. Maybe if the market was coming out of a big correction, it'd be a different story. But this one, it was so close here. Even at the end of the day, it was maybe within 1% of the profit goal. If you see that and it got close and it came back down, it's totally okay to take profits here a little bit earlier. This is a rare one where it reached very close to the 20% gain and just never got any higher. But you can see that this would be disappointing to, if you get stopped out here at a 1% gain or even here have to take like maybe a 10% gain or something. Okay. Next one is VNOM. This one had a base back in here. I bought it on the breakout right here. And this one I did take I just did the 20% profit goal and followed it. And this one worked out nicely. And if we just fast forward ahead here, okay, so here's the profit goal up here around 32. I just want to show what that looked like here. So this one actually triggered the profit goal on this day. And I had a limit order which got filled here and took that 20% profit. Now the thing I want to point out on this one is this one did end up going higher. It did end up, the profit goal, let's see here. Let's just say the profit goal was 31.50, right around here. Okay. Sold on this day. You can see it did go higher here temporarily. But if I would have held it for longer and not taken that 20% profit, you can see what happened here. The thing, it makes this nice move. It's looking great. And then all of a sudden the market starts pulling back a little bit. Actually, not even before the market did. This thing has this big pullback. Pulls back 22%. And all the way back to its prior buy point, actually. So if I would have held on to this, it would have ended up, I would have had to sell it for like a 1% gain. So there's definitely something to be said about selling while stock's still advancing, because you can see how quickly this thing came off the top here. It was down 7% this day, um, after taking a few weeks to get up this far. You know, it's all gone in a day. And then you can see actually here within 4 days, the stock retraces what it took maybe 2 months, a month and a half to make this move. It took maybe let's see, April to yeah, almost 2 months to make this move here, and then it's gone in only 4 days. So, you know, at the time, it's you might be disappointed if you sell it here and then you see it all of a sudden trading up another 5%, but um, selling while the stock is still advancing is the way to go, because I showed some other examples where if we didn't do that, we ended up frittering away most of the gains. Another thing I'll mention here is I went back and looked, and anytime this year a stock I owned hit the 20% profit goal, I looked at how often then does it hit a 25% profit. Because maybe I should start selling half of my position, half my shares at a 20% profit and half of it at a 25% profit. And I am going to start doing that, with one exception or one caveat, because I found that almost every time if the stock reached the 20% profit, it ended up reaching the 25% profit. My caveat here is what I'm going to start doing is if it reaches a 20% profit, I'm going to sell half my shares. And then I'm going to move my stop up to like a 15% gain, which will probably be around here. And if the stock doesn't go higher and it comes back down to a 15% gain, I'm going to sell the rest of my shares. And this is to protect losing any more of those gains. But if the stock, if I did sell, let's say some here, without doing the math here, I don't know if this one would have got stopped out, but if it didn't, I would have sold the rest of the shares, the other half right here. And based on the studying stocks that I've traded this year, that is a good strategy. Take half your profits at 20% and the other half at 25%. But if you're going to do that, raise that stop so that you don't end up having to sell half the shares at a 20% gain and then watch the other half come all the way back down like here to like a 1% gain or a break even. So to avoid that, move that stop up to a 15% gain, let's say, so that you're guaranteed at least a 15% gain on half your shares and a 20% gain on the other half. And you know, that's still a good gain to have. Okay, Goose. This is another one. I bought this stock here on this, had a really nice breakout week here after this base. This base was really nice. It had you can see how it tightened up on the right side. It had this move down here, and then it had a move down here, and these moves just got progressively tighter. And then we had a breakout day here on big volume. And what I want to point out with this is I had this stock, and so it broke out this day, and then within about 4 weeks, it hit the profit goal, and it was due to report earnings. And the stock had a history of a lot of I should say big moves around earnings. It was either up 15% or down 12% or up 17%. And I just thought to myself, I didn't want to take that risk of losing my 20% gain. And if the stock had been a smaller mover or more stable around earnings, I would have definitely held it because I had a lot of profit cushion. But I chose to sell it and lock in my gains and just be conservative there and not take the risk of holding through earnings. The stock was also pretty extended here. It was 20% above the 50-day moving average. And it just made this nice move, and I just thought it's pretty extended. From a third stage base, it's pretty volatile after earnings. I didn't want to hold it. And then you can see what happens here. The thing gaps up, closes up the day 33%, costing me thousands of dollars in lost profit. And so this was another good. Again, the trades I screw up the most are the ones I learn the most, and this was definitely one that I learned something. My thought after the fact here was, I had a 20% profit on this, and yes, it's been volatile after earnings, but what happened in the past in recent trades when I had a big profit cushion like this and didn't hold through earnings? And I went back and looked at what usually happens. And another example was Netflix. Netflix, I believe it was back here I bought the thing, and I'm trying to remember. It may have been back in here that I sold it, that it made did it make the profit goal here? Not quite. I'm trying to think where this was. I apologize. I can't think about this. I can't think of it offhand. But I look back at I had owned Netflix at one point, and I had about a 20% profit on it, and I sold it before the earnings report. And for some reason, I think it was here. I think actually it was back here. Yeah, it was back here. I bought it off this cup with handle, and I think held it through all of this, and it was at the profit goal up here, and or at least very close to it. And then it went and had this nice gap up move. I believe that was the one I'm looking at here, but anyways, something to think about in the future is that if a stock, if you're up like 20% on a stock, or you're up near the profit goal with earnings reports due, I did go back and look at some other examples, and the stocks traded up afterwards most of the time. So I think there's not as much risk here as I thought. I felt that the risk was actually elevated to hold through earnings, because the stock had just made this nice move and it was kind of extended. It's a third stage base. But actually, when I went back and looked at some other examples like Netflix, I found that was not true. And so my next stock, if it's near the profit goal with earnings coming up, I'm probably going to hold it next time, even if the stock tends to have kind of a history of big moves after earnings. All right, let's go through a couple more here. Dropbox. This is another case where, again, I had the same thought here on this of, well, it's as I did on PAGS. I was like, well, this is a really nice IPO setup. The market had just come out of, had a pullback, couple pullbacks here, and I thought I'm going to hold this for some longer term gains. And this thing ran up in 3 days and hit the profit goal. And I actually was caught off guard this day when my alert went off. I thought I had miscalculated something, but I saw that it was up 20%, more than 20% actually at points. And I wasn't ready to sell it. I had an alert, but I didn't have a limit order in yet, because I didn't expect it to have such a big update here. But even if I missed the chance to take profits, the next day it hit the profit goal again. So I could have, after the close this day, I thought about putting in a limit order, and I chose not to, thinking this is an IPO setup. IPOs are doing really well right now. The market was had a correction here, a small correction. Maybe this market's gonna run nicely for a while here. And I was wrong, and you can see what happened here. This thing completely retraced its move. So after being up 20+% in 3 days, I ended up having to sell the thing again for like a 1% gain. And so this is just another example here of take the profits when you have them most of the time, and especially when they run up quickly like this. You can see what ended up happening to the stock. It actually traded below the buy point. And it's come back a long ways off this peak here. It is holding the 50-day for the most part, but boy, would it have been nice to sell up here, which ended up being at least a short-term high. So just another example of selling into strength, especially unusual and quick strength like that. Okay, I'll go through the last two quickly here. Grubhub formed a double bottom here that I bought on this day. And what I want to talk about on this one, I'm sorry, actually, I bought this way down here as it undercut this 94 level and came back above it. I bought actually down in here, and then I bought the rest when it broke this trend line back here. And what I want to talk about on this one is this one ran up not quite to the profit goal, but it got up to maybe more than 10%, almost 15% above the profit goal, above the buy point. And I was actually up 20% from my purchase price in here. And I was thinking my portfolio and my stocks this week did tremendously well. Everything ran up a lot. And it was probably one of the biggest weeks I've had in my portfolio in a long time. Because I look every day at how much did my portfolio change in value. And this week, I just thought, boy, this looks like a short-term kind of climax run in these leading stocks and markets in the market. And I've actually now I call it kind of a portfolio climax. And I've got a new sell rule now that that I just added after this happened because I didn't sell this up here because it wasn't at my profit goal yet. My profit goal was up here. It was 20% from the buy point. It wasn't 20% from down here where I bought it. And you can see what happened. The thing ran up pretty quickly here over these few days, as did many stocks I owned, and my overall portfolio ran up a lot this week. And I thought this move is not sustainable. There's probably a big pullback coming. And I was right, but I didn't really do anything about it. And this thing pulled back all the way down to the buy point, and I ended up selling it for I don't know, a couple percent gain or something. And again, very disappointing. I was up 20% here, and I ended up selling for just a couple percent gain. So the lesson learned on this one, I thought I tweaked my rules also to say that if my portfolio runs up very quickly in a few days, and many of my stocks are running up are accelerating and advancing at an unusually high rate, then I need to sell my most extended names. And this was one of my most extended names at the time, which would have caused me to have to sell this. The other thing I added to my sell rules is that I have the option now to take profits either at the 20 to 25% range here from the buy point, or I can take that from my cost basis. So if my cost basis is way down here, I can take my profits at 120 even though it's not 20% from the buy point. And in this case, this would have given me actually two sell rules to sell this. One being that it's up 20% from my cost basis. The other being that it ran up quickly, along with my portfolio running up quickly. And the last example here along the same lines is Qualys, which I bought this day and thought, boy, this looks like a great stock. It had this nice shakeout day in here after earnings report. It was a nice cup. It didn't form a handle, but it looked really nice. And it had a gap up day here on big volume. You can see all this accumulation right here. And I just thought this thing's going to run up and hit the profit goal quickly, and I'm going to get out with a 20% gain. And I had a limit order in around here to sell if it reached up here, the 20% profit goal. And again, this was the same time period. My portfolio increased in value dramatically this week, and a lot of my stocks ran up very quickly this week. And a couple did reach the profit goal. Square I sold for a profit goal here around here, and Netflix. But I thought I should have sold more because this started advancing at this fast rate here, along with a lot of my other stocks. And I've just noticed this historically that when my portfolio runs up a lot in a short period of time and makes an unusual move, it's going to pull back, and it's going to pull back in a big way. And that's exactly what happened here. And I ended up again having to sell this stock for maybe a 1% gain after being up maybe let's see here, I want to say about 12%, 15%. It was up 15%, and I ended up having to sell it for like a 1% gain. And so I reflected on this one again. Like I said, I find that the trades I screw up the most are the ones where I learn the most. So my lesson learned on this one is this supports that new rule I have that if I have this portfolio climax, as I call it, a big move up all of a sudden, and stocks start advancing at a much faster rate, and my portfolio is gaining more than it's gained in a long time, I need to sell some stocks, and I need to sell my most extended names, the ones that are moving up the fastest, and this was one of them. So that may have allowed me to lock in maybe more like a 10 or a 12% gain here as opposed to a 1% gain. Okay, so I hope you find that useful, some lessons learned, and it's really useful to look back on your trades. I do this all the time, at least once a quarter, go back and look at all my trades, and I kind of look at there are a handful of trades that taught me the most, where I can learn the most. They're usually the stocks that I buy and then I have to sell them for a loss because they drop 7 or 8%. I usually don't have much to learn on those. I'm usually find out that was the right move. They usually don't end up rallying from there. And then stocks, likewise, if they run up 20% and I sell them, I usually don't have much to learn there either because they tend to not go up a lot more from there. But the ones where I find that I had a big profit and then I ended up not taking it, or I was up a decent amount of stock and ended up taking a loss or a really small gain, I feel like those are the ones that offer the best learning opportunities, and those are the ones I focused on here. So if you found this video on YouTube and you're not a member of the Meetup group, you can follow this link to join the group. You do need a free Meetup account, and why would you want to join the group? Only members are invited to our quarterly webinars, and I'll be scheduling one soon. And members are notified when new videos are posted to YouTube. There were no member questions from last month, and if you have any suggestions for future topics, please send them to me. And any questions, message me on Meetup. I answer all my messages on Meetup. So anything you want to talk about, let me know, and I'll try to include it in a future video if it would be helpful to others. All right, thank you, and I'll be posting the invitation soon for our next webinar. And happy trading, and let's hope these tariffs go away and we can start making some more money.